G'day, I'm Nick Erner. I'm the Managing Director and CEO of Alkane Resources. We're ASX and TSX listed under the ticker ALK. We've got 3 operating mines, 2 in Australia, 1 in Sweden. Matt, great to see you, mate.
Good to see you. Good to see you. Welcome to freezing cold London.
It's a bit blowy outside, yes.
But there's a smile on your face, and we know why. It's been a good year for you. Obviously,
Good.
I think the thing that I'd love to understand or catch up with you on is obviously the integration, how that's going, and maybe how that's benefiting the company. So, quick review of this year. A lot achieved. What are the kind of big things we need to look at?
Yeah, so we're obviously referring to the merger with Mandalay Resources, which completed in early August. So if we look at those objectives that Fraser and I had and the respective boards had, first one was, let's increase production. Let's approach 180,000 ounces. So this year's guidance, so July to June next year, is 160 to 175. So we're on the way.
160 to 175.
160 to 175,000 ounces. So we're on the way, but yet to tip over that, we want to be at that run rate by the end of next year. We wanted to increase liquidity. That's significantly occurred. Typical turnover on the ASX now is about $8 million a day, TSX about $1 million Canadian a day. We wanted to achieve index re-ratings. We're firmly in the ASX 300 and nudging up towards the position of the 200. We wanted to see a corresponding re-rate of the shares. You know, the market cap at time of pro-forma merger was circa 900 million Australian. It hovers around 1.4 billion Australian at the moment. It's a pretty volatile gold environment. And we wanted to be debt-free, which we are. We wanted to improve our liquidity position. We've got 170 odd cash and bullion Aussie in the bank and no debt apart from the equipment finance. So we've certainly achieved those. We've created that platform. The cash flow generation is remarkable because gold prices, of course, continues to rise. So yeah, we're in really, really positive space for the existing operations and for growth options.
Right. Now, when you decided to come together, conversations start a long time before they actually conclude.
Yeah.
The market was very different, right? Yeah. It looked positive, but nothing like it is today. Yeah. The objectives that you've just laid out make a lot of sense for both of you. So I say generally the merger has been a success from that point of view. The market understands it. Now, we are in a different environment. Do you behave any differently? Do you target any differently? I mean, give us your thoughts on that.
Yes, I'll cover 2 aspects. I think operational behaviour is always to try and contain and constrain your costs in this environment. However, the increased cash flow, significantly increased cash flow, and so if you're doing 160,000 ounces, now 20% of ours is hedged, but just run with, say, 150,000 ounces, then logically, you know, each $100 you add to the gold price adds $15 million, right? So it's, you know, substantial difference. The one thing we are doing differently is we're looking very closely at our capital allocation across each site, but particularly in Sweden at Björkdal, to say, how could we apply capital to lock in future permanent cost reductions? So that's a change, that we're looking a little more liberally with how we apply capital. Don't have any answers on that yet, but we're certainly looking at that. So that's number 1. Number 2 is when you look at merger and acquisition, so future growth, then the type of things that we're looking at, and I've said it a number of times to people, we're looking Australia, New Zealand, Canada, US, we're looking Sweden, or Scandinavia. The kind of things that we're looking at is we're certainly open to buying a developer provided permitting was done, provided we could develop it and have it running inside a 2-year period from here. And more of those things are becoming available to look at because I think the price incentive means that the capacity to repay that really quickly and then lower the debt for investors there's more opportunities there. Now, some of those valuations are lifting, so that might restrict the transaction for another purpose.
Here's the thing I want to get to within this conversation, right? Because I see in markets like this, money becomes readily available if you're looking for to raise capital. Money becomes more available because you're producing cash flows and hopefully margin. Therefore, so it's a sort of, with the right thought process, it's an enabler. With the wrong thought process, it's a corruptor. in the sense people
Totally, yeah.
make the wrong decisions at the wrong time, at the wrong price, with the wrong conditions and wrong end goals. So how do you kind of stay pure of thought?
Yeah, so people have the capacity for the right and the wrong decisions at any point of the price cycle, but I completely get the point. So I think things that are, it's very relevant to understand always your own value. That's the most important things to understand, because we've talked previously about your actual cost of capital. So to illustrate that, let's say our price is $1 billion and we think our net asset value is $1.5 billion. Then your price to NAV is 66%. So that means were I to go out and spend a real dollar and I raised equity for it, logically my cost of capital is already 33%. Okay, so I need a superior return for that dollar because I've just issued new capital. Of course, it's different if you're spending cash. So what it means is that because that's a dollar, right? But you could buy your own shares nominally, and with that buyback, then therefore get a 33% discount as you see it. So you're always weighing up that opportunity. And I think if you lose sight of what your own price to NAV is, and then you chase an opportunity that's got a price to NAV of 1 and you're at 0.7, then unless you're going to make it that 33% plus, then you've got a problem. So then people can sometimes lose sight of that, or they can give themselves an incredibly aggressive valuation, in order to make someone else's value appear thin. So that is a problem that exists at the moment as we look at developers. So if our price to NAV at the moment is say about 0.7, which it probably is depending on gold price, then quite a few developers are approaching 0.6, right, on some metrics. And so therefore, you're pulling all that development risk on and trading on that, but it's trading as if they're a producer already, like we are, right? Whereas traditionally, developers might have been at 0.35, 0.4, so therefore, right. So I think understanding that.
Why is that changed?
Development rate. Oh, why has it changed?
Yeah.
I think availability of capital and optimism. So like the margin, logically, price to NAV should rise as the risk decreases. Then of course you can get it funded and then the margins look great. Then logically your PNAV should rise. Yeah.
But to me, I'm looking at execution risk as something which is not kind of factored in here.
Sure. I totally agree with all those points. But all I'm saying is that's why it has in general moved. Yeah.
Okay, interesting.
Sentiment driven, yeah.
Okay, and we'll come back to that point in a second, because I think we've jumped to, all stories like yours should tell a growth story, right? There's a growth component to what we do. M&A seems logical. People would expect that. It's the simplest thing in many ways.
Yeah, and then corresponding free cash flow is high. Exactly.
Right.
Yeah.
Okay. So, but you've also got to take care of the knitting and say, look, okay, we've got a whole bunch of our own internal execution, operational execution to take care of. It's important that we do that. And it's kind of like people expect that, but it's not easy. You've got to have the team to actually deliver that. And if we were saying before we started, if I look back 2-3 years about where you guys were at, and a lot of companies like yourself were at, it was different times. The thing that's changed is obviously gold, as you just said, gold price has changed. The expectation is therefore gold, that gives you margin, and there's this hope that in this turmoil of this political environment we find ourselves in, it will continue to be that way. You can't think like that from an operational perspective before you go leaping off and doing M&A, can you?
Well, obviously we have to have a view of gold price in order to do a transaction, right? So there's no point locking in, like if you think the gold price is going to be 4,000 US and you're evaluating an opportunity that's 3,800 US, then you want to be bloody certain it's 4,000 US, right? So you've got to have a view on the gold price in terms of a transaction. But you're completely correct in that the things that we can actually control, not fool ourselves into thinking we are controlling, is our mine plans, our geographic interaction with the government, our impacts, and our cost base and structure. And we cannot ever lose sight of that. And I think it's super easy, like in this.
But how do you weight it? How do you weight that?
How do you weight that?
There's the execution and organic growth and the cash that it produces, which is fantastic. And you can say, the market should measure it this way, okay, because we will continue to do this for X number of years. Versus let's take a look at that cash and say, do we weight it over towards existing projects? In which case, let's put 60% back into that. And we'll maybe think about some kind of dynamic growth through acquisition, locally or wherever. How do you view that?
Let me see if I answer the question that you're asking with this. Yeah. So if we first look at how we allocate our time, right, by far and away the vast majority of the organisations, we've got nearly 1,000 employees, everyone but 10 of those employees is focused on the existing business, the forward-looking mine plans, accurate control, all that sort of stuff. If you then look at the way we allocate cash, so let's say like our nominal cost structure this year, because of just different between mines, people can look at our guidance, let's call it 2,700 Aussie, all right? And then we have a gold price of 6,000. So for the ease of maths, we're just going to say...
We're in Aussie dollars right now.
In Aussie dollars. For the ease of maths, we're just going to do 160,000 ounces times 3,000, right? So you got whatever that is. Yes.
That number.
So that number. If you then pick up that money, and what do we do with it, right? We pour the vast majority of that isn't going into the cash. We put that into sustaining capex, and we put that into growth capex at the operations.
Right. Okay.
And most of that sustaining capex and growth capex, in our case, is about holding the cost position where it is, and holding or increasing production slightly, and extending the mine lives at the current run rate.
It's literally sustaining. That's the keyword there.
It's sustaining. It may be growth because it's a step extension and stuff like that.
Yeah.
So that's where a large part of our growth capex goes. And if you look, for us this year, that's circa $80 million Australian, roughly, right? Of that nominal amount that I just allocated. The rest of ours is being saved into the bank balance. Obviously, some then goes to pay tax, because we are in a happy tax-paying position. If we could pay $10 billion tax, imagine how happy we'd be. But so that's where that goes. The rest of it, then, we have a choice. We will generate, if gold price stays the same, circa 180 odd million Australian this year, 250 the next year, 350 the year after. It needs that to stay where it is. So we are looking at the acquisitions that we think will add value materially beyond the percentages that we have. And then once we've run some of them aground across the next 6 to 12 months, we'll also be looking at, well, how do we return this money to shareholders? And I don't know the answer to that yet, because we haven't run the M&A aspects of that to ground yet.
What's the cost of that? What's the cost of that process? Because you'll for every 5 companies you look at, one might kind of go a little bit further down the line. Do you know what I mean? Because there's lots of ways these things fall over.
Totally. Yeah.
What do you spend on that?
So we would allocate 1 to 3 people's salary on that, and time on that.
The DD,
then you include consultant. Oh no, you see, that's before you do DD and lawyers, right? If you take a process, a typical process, then we will have engaged, typically external to any brokers or bankers, and it'll be a portion of a person's time. So let's assume we're paying a person a couple $100,000 a year, so it's, I don't know, we spend $100,000 on salaries for that. They will, of course, be looking at other stuff. Then we have an approach to someone. They may or may not open a data room. To spend $50,000 to $100,000 on a study of the data room, data and time, and getting our internal reports on valuation would be typical. And we might do 5 of those in a year, in reality.
So you're not blowing your brains out.
No, but then if you take, let's assume we said, we're going to do a handshake agreement, like broadly, we're zeroing in, and let's agree that if we agree on $500 million, we're going to go and get it done. We would then spend $1 to $2 million on lawyers' fees and due diligence and detailed stuff, whatever.
Right.
But you may do that once or twice a year, max. Yeah.
Okay, but you got the cash to do it, so it's kind of irrelevant. I guess.
And you're also not doing it unless at a handshake / non-binding agreed level, you're agreed on the outcome at the start, right? So you already know, this meets our return criteria, our risk criteria, our jurisdictional criteria, right?
So you do that once or twice a year on a non-binding basis. You would hope to be able to move to a binding situation with one of those at some point. It could still fall over. It's fine. But again, it still doesn't sound like a whole bunch of money on this one. I guess people will be measuring you on how quickly can you get one of these things over the great unknown.
It is the great unknown, and people will appreciate that the volatility that exists brings both risk and delay and the occasional opportunity. So, but we would very much like to do the next leg of growth, which is what the board is looking to do within a 12-month period. Absolutely.
Okay.
We'd like to do that. Yeah.
Oh, that's quietly confident.
Yeah, we would like to. Well, there's a difference between liking to do something and actually landing it. Yeah.
But here's interesting, and this is probably maybe not saying an Alkane thing, but it's certainly your experience would be welcome here. Is when we look at the amount of sort of DFSs or bankable feasibility studies, that's what you want to call them, that get produced. Yeah. When you look at those things, do they all stand up to scrutiny in some way, shape, or form in this gold price environment, or is there still some technical issues which you say actually
to different degrees, right? So in general, if someone does a DFS, definitively, in general, the permitting situation that people describe may often have one or two more hurdles than potentially they've even anticipated. It could be, the fine detail of a particular water extraction license or something like. So it's not the major permit; it's a sub permit, and that can often add months, right? And they just might not be aware of it. If they're operational people, they're probably already aware of it. If they're just developing, they're probably not aware of it. Mm-hmm. In general, because things are not yet tendered, depending on the contingencies and how old their pricing is, that we would typically add a contingency on top of the contingency. Yeah. But of course, being operational and doing project development, we have the capacity, this big database behind us, just go, boof, that's our lived experience here. Yeah. And in general, metallurgical work is done well, but not necessarily as extensively through the ore body as we would do operationally with time, which is fine, provided you don't fully price that success into whatever you're doing, right?
When you also, and sorry to go down this line, it's just, I think it's really, really interesting at the moment because, as I say, there'll be lots of new projects on the table, and I'm just want to get a sense of your risk aversion or de-risking protocols. When you're looking at different jurisdictions at the moment, I was saying sort of, some rioting in Mexico. That doesn't help for, silver type stories. But you've got companies that will say, "Well, I'll take that risk on right now," or like a G Mining, and say, "I'll take this sort of the great unknown of working in Guyana," versus others say, "No, I need tier one jurisdiction. I need to be in Canada. I need to be in wherever they need to be."
We fall into that latter group. Right, we are Australia, New Zealand, USA, Canada, Scandinavia.
Okay.
Right, and I think there are a couple of different reasons. One, that our shareholder base is investing in a company that's already invested in tier one assets. Mm-hmm. So their expectation is that we will continue to operate in stable and reasonable jurisdictions. And so people tend to divide hemispherically, okay, well, I'm South American focused, or I'm African focused, or I'm tier one focused, right? So we're tier one. We of course get amazing opportunities come past your desk of half-ounce dirt on a 4 million ounce deposit in some particular part of Africa, but it's just we just think that the risk reward for that would be a risk reward set that's different to our existing risk and reward set. Now, if I went and polled all our existing shareholders and said, "Well, do you want us to go from risk reward set A to risk reward set B?" They'd be like, "Well, no, thanks very much. I'll go and invest in an African focused company because they do risk reward B. You stick to risk reward A."
Well, it's risk reward, but it's also experience. right?
Oh, totally. Yeah.
Can you operate in that kind of
Yeah,
environment?
we don't.
Like a Lundin, historically, you go, they don't mind a bit of risk, a bit of hair on the project. Most of us would say, no, thank you very much.
All of that stuff.
Yeah. Okay. Sorry to kind of segue off there. With regards to obviously the integration proper, you've been visiting in Scandinavia. You've been up there in Finland and
in
Sweden, I should say.
In Sweden, northern Sweden. Yeah.
How are things? Is that the first time you've been there, or?
Oh no. We've been there during due diligence and a couple of times since. The full board was there 8 weeks ago,
right? Okay.
maybe.
Yeah.
Look, I mean, these are established operating mines that have been operating in Sweden's case since the mid '80s, right?
Yeah.
So, at the case at Bjorkdal, so yeah, it's good, motivated team on site, determined to get stuff done. It's great, right? So, the normal things of there's this understanding the business, and then there's this whole different set for the entire group, not just Mandalay Resources, but Alkane as well, of, okay, we're in this price environment. Is there growth capital that we can allocate that will shift and set this up for the future? It's particularly relevant at Bjorkdal because it's our highest cost operation, but it has the longest reserve life. And so making that shift there has the biggest leverage for us.
How do you change that?
Well, there is an open cut that the team's working on that lets us substitute some low-grade stockpiles for open cut resource that is higher grades. That's one thing. There's a new mining area we call Storheden, which is at 600-700 metres underground, that if that's worked up over the next 12 months, could do another mining area that lets us lift from 950,000 tonnes to 1.2 million. There are some satellite things, but they're more in the 4 to 5 year time frame. So they're the things that we're looking at. I'm talking about moving from this 40 to 45,000 to 50 to 55,000. That you just do the maths on that. That logically should knock 20-25% out of the all-in sustaining cost, which sees us move from that 2,700 US, down to sort of close to 2,000, 2,200 US. That would be a great position to be in. So yeah, the team's pretty motivated on that. We're doing a fair bit of drilling there. We're always looking at mining method and mining efficiency, but it's quite an efficient team, allocation of contractors. Yeah, but the main thing is those different things I said, ore sources and the capacity to lift to 1.4 million tonnes of higher grade.
Right.
Yeah.
Obviously, you've kind of given a sense of the guidance for next year, 160, 175.
Yep.
Whatever that nets off after hedging, etc. What should we be judging and grading? And I know you haven't given guidance for next year necessarily in terms of all things.
We want to do the same or a bit better, obviously, next year. Yeah, because some of these things, particularly at Costerfield and Bjorkdal, we want to have a difference. And we very much did due diligence on each other, saying 180 is our target, right? Or moving towards 180. I think the key thing for us is obviously let's put the growth M&A to one side. We want to see the Tomingley Highway move continue.
Right. So it's
right.
A big take.
We want to see resources expand at
completed
Costerfield.
Next year.
It's 14 months from when we kicked it off, barring extreme weather events. So it won't be quite in this financial year, but it'll be. Yep. We want to see resource expansion at Costerfield.
Yep.
We want to see the costs come down at Bjorkdal.
Yeah.
But most of all, I think everybody wants to see. They want to see our cash balance rise because it should be rising faster than most of our peers. It should, yeah.
And that's a war chest for acquisitions.
It's not just a war chest for acquisition. But it's a value relativity basis, right? So
explain that.
What I mean is, if you look at a group of companies who are producing whatever ounces, but it will go 160 to 175, so 170,000 ounces, a group of companies, and they all produce $200 million a year, logically, for similar mine lives, they should all have the same valuation. Logically, right? And so all I'm saying is that I think that as we generate cash and people look at those differentials in valuation, we should appreciate to be more reflective of where some of our peers are at. But we need people to be familiar with the Costerfield asset, familiar with the Bjorkdal asset, and just see us bank in the cash. Absolutely, yeah. And I think we'll do that, and I think that'll be pretty interesting to watch.
Good to see you.
Thanks,
Good
mate.
to see you.
It's
That's going well, and
it's going great.
like I say, next year, shaping up.
It's definitely shaping up. Yeah, it'll be good to tell you all about it.
Good. Okay, mate.